What if I told you that the 1929 stock market crash wasn't a surprise? What if the men in charge, the very people who built the Federal Reserve to prevent panics, saw the entire disaster coming and chose silence over action? Not incompetence, not bad timing, deliberate, calculated silence. Because here is what they do and teach you in school. Multiple warnings flooded into the Federal Reserve throughout 1928 and early 1929. Internal memos, urgent letters from regional bank presidents, even warnings from European central bankers, who watched America's speculative mania with absolute horror. And the response? Nothing. The Fed sat on its hands while margin debt exploded, while everyday Americans mortgaged their homes to buy stocks, while the entire financial system built itself on a foundation of pure delusion. And if that sounds familiar, if that makes you think about 2008, about the current everything bubble we're living in right now, about your shrinking paycheck and exploding rent, good. Because the same playbook is running again. The names changed, the instruments got more complex, but the game? Identical. Before we go further, drop a comment and tell me where you're watching from. This channel doesn't sugarcoat financial history. We don't repeat the textbook lies. If you want the unfiltered truth about how the system actually works and who it actually serves, hit that subscribe button right now. Because what I'm about to show you will permanently change how you see the Federal Reserve, how you see market crashes, and how you see the precarious position we're all in today. Let's set the scene. The Roaring '20s. America is booming. Industrial production is skyrocketing. Consumer confidence is through the roof. The stock market? Absolutely parabolic. Between 1924 and 1929, the Dow Jones nearly quadrupled. 400% gains in 5 years. People who'd never invested before were suddenly stock market geniuses. Cab drivers were giving investment tips. Shoeshine boys had portfolios. Sound familiar? But here's what made it all possible. Margin lending, buying stocks on credit. In 1929, you could walk into a brokerage with just 10% down and borrow the rest. 10-to-1 leverage was standard. Some brokers offered 20-to-1. Imagine buying $100,000 worth of stock with just $5,000 of your own money. The rest? Pure borrowed cash, secured by the stocks themselves. This wasn't investing. This was a leveraged bet on an endless rise. And the Federal Reserve, created just 16 years earlier after the Panic of 1907, specifically to prevent this kind of speculation, watched it happen. They had the tools. They had the authority. They could have raised interest rates aggressively to make borrowing expensive and cool down the fever. They could have implemented margin requirements to limit leverage. They could have used their bully pulpit to warn the public. They did none of these things. Why? Because the boom felt good. Corporate profits were real. Unemployment was low. Tax revenues were pouring in. And the men running the Federal Reserve, particularly Benjamin Strong, the governor of the New York Fed, believed they had mastered the business cycle. They genuinely thought they could fine-tune the economy with small, technical adjustments to interest rates. The hubris was staggering. Sound familiar? But let's talk about the warnings they ignored. In 1928, Paul Warburg, one of the actual architects of the Federal Reserve System, published a stark warning in the Financial Chronicle. He wrote that if the speculative orgy continued, the ultimate collapse would bring about a general depression involving the entire country. Not a correction, a depression. And Warburg wasn't some outsider. He was a founding member of the Federal Reserve Board. He understood the system from the inside. The reaction? He was mocked, ridiculed, called a pessimist and a fear-monger. The market kept climbing. Then there were the internal warnings. Regional Federal Reserve banks, particularly the ones outside New York, started sending urgent communications to Washington. They were seeing dangerous credit expansion in their districts. They were seeing banks make increasingly risky loans. They were seeing the classic signs of a speculative bubble. But the New York Fed, the most powerful arm of the system, dismissed these concerns. Strong and his successor, George Harrison, believed they knew better. Here's where it gets truly disturbing. The Bank of England, watching America's speculative mania from across the Atlantic, repeatedly communicated concerns to the Federal Reserve. European central bankers had seen this movie before. They knew how credit bubbles ended, and they were terrified that when America's bubble burst, it would take the entire global economy down with it. Which, of course, is exactly what happened. Sound familiar? Think about the warnings before 2008. Think about the analysts who were called crazy for predicting the housing collapse. Think about Michael Burry, Steve Eisman, the people who saw the subprime disaster coming and were laughed out of rooms. The pattern repeats because the incentives never change. But here's the mechanism they should have stopped. Call money. This is crucial. Call money was the overnight lending market where brokers borrowed cash to fund margin accounts. And the interest rates on call money in 1928 and 1929 were absolutely insane. We're talking 8%, 10%, sometimes 15% for overnight loans. Those rates were screaming that demand for speculative credit was out of control. The Federal Reserve saw those rates. They published them in their own bulletins, and they did nothing. Because corporate America, the big banks, even foreign lenders, were making a fortune supplying call money to fuel the stock market. Everyone was getting rich. Why stop the party? Now, here's where this story takes a dark turn. Because in February 1929, 7 months before the crash, the Federal Reserve did finally acknowledge the bubble. They issued a formal statement warning against speculative excess. The market wobbled, credit tightened slightly, and then, just weeks later, they reversed course. Why? Political pressure. The Coolidge and then Hoover administrations made it clear they wanted the boom to continue. The business community demanded easy credit, and the Federal Reserve, despite its supposed independence, folded like a cheap suit. But there's a name you need to know, a decision that sealed the fate of millions. In August 1929, just 2 months before Black Thursday, the Federal Reserve raised the discount rate. This is the rate they charge to member banks. They raised it to 6%, the highest level of the entire decade. On paper, this looks like they were finally trying to cool things down. But the timing was catastrophic. Instead of gradually tightening over years to prevent the bubble, they waited until the absolute peak and then slammed on the brakes. It was the worst of both worlds. They let the bubble inflate to maximum size. Then they popped it deliberately with a rate hike that drained liquidity from the system at the worst possible moment. Was this incompetence or something darker? Because here's what happened next. You won't believe the receipt. The documents that show they knew exactly what that rate hike would trigger. Let's break down the actual mechanics of how this whole system was designed to collapse. Because this isn't just about stocks going down. This is about the deliberate architecture of a debt trap that transferred wealth from the middle class to the banking elite on a scale never seen before. First, understand the margin call cascade. When you buy stocks on 10-to-1 leverage, you're essentially renting $9 for every $1 you own. If the stock goes up, you make 10 times the profit. Beautiful. But if the stock drops 10%, your entire equity is wiped out. You get a margin call. The broker demands you either deposit more cash immediately, or they sell your stocks to cover the loan. Now imagine this happening, not to one person, but to millions simultaneously. That's what began on October 24th, 1929, Black Thursday. The market had been wobbling for weeks. Investors were nervous, and then the selling started. As stocks dropped, margin calls went out. People couldn't meet the calls, so brokers liquidated their positions. That selling pushed prices down further, triggering more margin calls, more forced selling, more panic. This wasn't a natural correction. This was a systemic implosion built into the structure of margin lending. And the Federal Reserve, the institution supposedly designed to be the lender of last resort, to provide liquidity in a crisis, did nothing. They watched the cascade and let it run. Between September 3 and November 13, 1929, the market lost 40% of its value. 40% in 9 weeks. But here's the number that should haunt you. By the summer of 1932, at the absolute bottom, the Dow had lost 89% from its peak. 89%. A decade of gains obliterated. But it gets worse. Because the stock market crash was just the beginning. The real devastation came through the banking system. Remember, The same speculative fever that infected individuals also infected banks. They weren't just lending money for stock speculation. They were speculating directly with depositor funds. When the market crashed, their capital was wiped out. And when banks started failing, depositors panicked. In 1930, 352 banks failed. In 1931, 1,782 banks failed. In the first quarter of 1933 alone, 4,000 banks collapsed. 4,000. These weren't small rural banks. These were institutions in major cities holding the life savings of ordinary Americans. And there was no FDIC yet, no deposit insurance. If your bank failed, your money was gone, completely gone. Estimates suggest that by 1933, 9 million Americans lost their entire savings. 9 million families saw every dollar they'd worked for vanish. Now, the Federal Reserve had the ability to stop this. They could have acted as lender of last resort, providing emergency loans to solvent banks facing temporary liquidity crunches. That's literally why they were created. But they didn't. They let the banks fail. They let the money supply contract by a third. They turned a stock market crash into the Great Depression. Why? Here's where we need to talk about the liquidationist theory. This was the dominant economic philosophy among the Federal Reserve leadership and Treasury Secretary Andrew Mellon. The idea was that depressions were necessary and healthy. They purged the rot from the system. Inefficient businesses should fail. Bad debts should be liquidated. The economy would emerge stronger. Mellon's actual advice to Hoover was, liquidate labor, liquidate stocks, liquidate the farmers, liquidate real estate, let it all burn, purge the excess. This wasn't conspiracy theory. This was official policy. They believed suffering was necessary medicine. But here's what liquidationism really meant in practice. The largest transfer of wealth in American history. As millions lost everything, as foreclosures exploded, as businesses collapsed, who was buying? The banks. The same institutions that had fueled the bubble, that had made fortunes on margin loans, now foreclosed on properties for pennies on the dollar. They bought factories, farms, homes, entire companies at liquidation prices. The Federal Reserve's inaction wasn't failure, it was facilitation. They created the conditions for consolidation, and the numbers prove it. In 1933, just 42 corporations controlled half of all business wealth in America. 42. The Depression didn't destroy capitalism. It concentrated it. Let's talk about a specific mechanism that made this possible. The call loan market collapse. Remember call money? The overnight lending that fueled margin trading? In October 1929, that market completely froze. Lenders stopped lending. Brokers couldn't access cash. The entire structure of speculative credit evaporated in days. But here is the dark detail. The Federal Reserve Bank of New York had complete visibility into call money rates. They published them daily. They watched the market seize up in real time. And they chose not to inject liquidity. They had the ability to become the lender of last resort to the call money market, to prevent the cascade. They didn't. Why? Because doing so would have been seen as bailing out speculators. The political optics were terrible, so they let the market collapse, let the liquidation run its course, and millions of ordinary Americans paid the price. Now, let's connect this to today, because the same mechanism exists right now, just with different names. In 1929, it was margin lending and call money. In 2008, it was mortgage-backed securities and the repo market. Today, it's everything. Margin debt is at all-time highs again. The repo market is bigger and more fragile than ever. Private equity has leveraged entire industries. Crypto operates on even more extreme leverage. And the Federal Reserve? They've learned nothing. When COVID hit in 2020, when markets started crashing in March, what did the Fed do? They injected $5 trillion in 18 months. $5 trillion. They backstopped everything. Corporate bonds, junk bonds, ETFs, even individual corporate debt. They prevented any liquidation whatsoever. They proved they will bail out the system when elites are threatened. But in 1929, when it was farmers and factory workers and small savers losing everything, they did nothing. The double standard is the point. The Federal Reserve doesn't serve the public. It serves the financial system. And when that system needs to consolidate, needs to transfer wealth, needs to buy assets at distressed prices, the Fed steps aside and lets the collapse happen. Here's another parallel that should terrify you. The warning signs are identical. In 1928, the professionals started getting out. Insider selling accelerated. The smart money was quietly heading for the exits while they told the public everything was fine. Today, CEOs are selling stock at record rates. Insider selling has hit levels not seen since the dot-com peak. Billionaires are liquidating positions while CNBC tells you to buy the dip. The playbook hasn't changed because it works. Inflate the bubble with easy credit. Ignore the warnings. Let retail investors and ordinary savers pile in at the top. Then tighten suddenly, trigger the collapse, and buy everything at liquidation prices. Rinse and repeat every 20 to 30 years. And here's the most disturbing parallel: the role of propaganda. In 1929, the media and political establishment insisted everything was fine until the moment it wasn't. President Hoover assured the country the economy was fundamentally sound, even as banks were failing. Treasury Secretary Mellon said it was a healthy correction. The experts told people to stay calm and keep buying. Sound familiar? How many times in the last 5 years have you heard transitory inflation? How many times have you been told this time is different? The Fed has tools. They've learned from past mistakes. It's the same script. And the reason it works is because most people can't conceive that the system itself is designed to periodically destroy them. So where does this leave us? Here is the uncomfortable truth. The system we live under today is exponentially more fragile than 1929. The leverage is higher. The debt is bigger. The interconnections are global. When the next collapse comes, and it will come, the cascades will move at the speed of algorithms, not telegram wires. The Federal Reserve has painted itself into a corner. They've blown the everything bubble. Assets are divorced from reality. Housing, stocks, bonds, crypto, all simultaneously overvalued because the Fed has suppressed interest rates and pumped liquidity for over a decade. But now inflation has forced their hand. They have to tighten. They have to raise rates. And when they do, the margin calls will start again. The difference this time? The moral hazard is complete. Everyone knows the Fed will eventually bail out the system, so leverage has gone parabolic. Risk management has disappeared. Nobody believes the music will stop because they have been conditioned to believe the Fed will always restart it. But what if they can't? What if the inflation is too entrenched? What if political pressures prevent bailouts? What if the next crisis is too big even for central bank money printing? These aren't hypothetical questions. These are the realities staring us down right now. The lesson of 1929 isn't that crashes happen. It is that the crashes are allowed to happen when they serve the interests of consolidation and wealth transfer. The Federal Reserve had the tools to prevent the Great Depression. They chose not to use them, and they'll make the same choice again when the time is right. When the asset prices are low enough. When the transfer is complete. You cannot trust institutions built on borrowed time. You cannot trust a system that has repeatedly proven it will sacrifice the many to protect the few. The denial is the danger. The belief that this time is different, that they've learned, that the guardrails will hold. That belief is what gets you destroyed. So what do? You acknowledge reality. You understand that the game is rigged, but you still have to play. You protect yourself. You reduce leverage. You hold real assets. You build skills and relationships that matter when the monopoly money stops working. You prepare for the liquidation, because it's coming. Maybe not this year, maybe not next, but it's coming. And most importantly, you stop trusting the people in charge. They knew in 1929. They know now. The warnings are there. The data is screaming, and their choice to ignore it, to keep the bubble inflated, is deliberate. Because they're not trying to prevent the crash. They're trying to time it. The Federal Reserve silenced the warnings in 1929 because the bubble served their purpose. The collapse served their purpose. The consolidation served their purpose. And your suffering, your savings, your future? That was just collateral damage in a game you didn't even know was being played. So here is my question for you. Are we wiser now, or walking the same path in better suits? Drop your thoughts in the comments. Share this with someone who still believes the system works. And if you want to keep getting the truth they don't want you to hear, hit that subscribe button and turn on notifications. Because the next chapter of this story is already being written, and most people won't see it coming until it's too late. Don't be most people.